Okay, I want to see a show of hands. How many of you have been on vacation recently? Okay, of those people, how many of you looked at property while you were on vacation? Okay, good. We got a couple people. Those are my kind of people. Some people go on vacation and say, oh, look at the sunset. I go on vacation and go, ooh, look at the mold. Yeah, so I am a real estate investor. I've been a real estate investor for years. My wife, when people asked her why she picked me, she said, oh, he was a cute little fixer-upper. He had potential for good cash flow. So, yeah. So I've been a real estate investor since 1986, and I managed a property for my dad prior to that. So I've got real estate in my blood, and I love it. You know, I think about it, like I said, I go on vacation to look for more property. That's my idea of fun. Kick the hole in the wall to, find more, are those termites? Yeah, those are termites. Okay. So anyway, I'm a tax guy. I've been a tax guy with real estate investing. In my first 4 years, I probably didn't work with that many real estate investors, but since 1987, I've been working with real estate investors. And when I went on my own, I did a bunch of stuff in my big firm. And when I went out on my own in 2002, I focused almost entirely on real estate investors. It's commercial, single family, apartments, land, you name it, I worked with it. So, but I love the single family investors because I'm one too. I would never invest in commercial property. It's too risky. I think that owning rental real estate is less risky than the stock market. So that's my perspective. So you'll see some things in this that will reflect my perspective here. So let's get started here. We've already talked about, this is not, don't take this to the bank. If you think something applies to you and you want to know more about it, seek professional advice. Don't just go off of what I say here, because everybody's situation is different. You may not hear it right. So call advisor, call me. I've got bandwidth for more clients, and I'd be very happy to help you. Okay, tax treatment of income and expense from real estate. Let's start with your goal is to make money, and my former partner used to say it's all about cashing the rent check. So we'll start with the income side. We'll go through some of the expenses, and then we'll talk about some of the rules related to. And if I bore you, it's only because I'm a tax guy and I'm an accountant. I'm a linear thinker, and a lot of you are a lot more creative than I am. So let's get going here. So we have the tax treatment of income and expenses from real estate rentals. And we'll start out with a couple of things. We all know that rent. We all know that rent that's where your income starts. But we got a couple of special things related to rent that rules that a lot of people don't know. Is that the prepaid rent that you get, some markets you get prepaid rent, some markets you don't. But in the prepaid rent, the first and the last month rent are both taxable when you get them as rent. Okay, so we're starting up at the top line of your income statement. The prepaid rent is income, but deposits aren't necessarily income. We all have an option here. We can either keep track of our deposits and hold on to them and not include them in our income, okay? And then when we return the deposit, we'll spend our money to do the fix-up, keep whatever's out of the deposit to pay for that. You won't deduct the expenses to clean it up. You'll just remove it from the deposit, and then the rest becomes income to you. Basically it offsets. You give back with no deduction what part of the rent you give back, what part of the deposit you give back, and then the rest goes to cover the expenses that you had. So a lot of people get the money, they just don't want to keep track of it. They take it into income, and then they deduct the deposit when they give it back. So that's your basic income line of your tax return where you're reporting the rents. We have a lot of expenses. I get a lot of questions. I mean, we can all pretty much figure it out that you're getting maintenance, property management, insurance, utilities, interest and property taxes and repairs. But a lot of people don't realize they can get their auto and travel expenses. A lot of people don't realize that we'll go into something called depreciation, and then question marks on your startup expenses, in particular education here.
Bob, we can't see your lovely slides.
All right. Yes, we are in a small room here, so I'm gonna go get up here. Yeah, you're welcome. No, I do like to wander, so I may wander back there. Anyway, so auto and travel. If you take time to visit your rentals, whether they're 5 miles away or whether you're hopping on a plane to go visit your rentals, as I did in Dallas this summer, that's an expense that you can deduct against your rentals. If you're going to and from, maybe you self-manage and you do some of your own repair work, take the mileage going to and from. I see virtually everybody seems to miss this. Next thing I want to talk about are the startup expenses and education. Education for basically the role here is that you can deduct once you own your first rental. This is an incentive to go out and get a rental for those of you who don't have one yet. Is that as soon as you have a rental, you're in the business. Now you can't deduct the education to get in the business. That's true of any business that you might get into. But once you're here, once you have your first rental, you're in the business, and now your education to become a better investor becomes deductible. Kathy's book is deductible. How's that? And then startup expenses. You can have a lot of things related to travel to a market when you buy it, that sort of thing. For that first one, we don't get to deduct that as a regular expense, but we do get to deduct it as a startup expense, meaning that once we've bought the rental, all the first rental, all the costs that we have related to going there and picking up that property becomes what we call a startup expense, and then we get to write it off when we finally put that into service. Okay, so these are some expenses that a lot of people don't know about. A lot of people confuse cash flow and taxable income. Most of the items that you get in your cash flow are folded into computing your taxable income, but the principal that you pay is obviously coming out of your cash flow, but not a taxable deduction. But we replace that principal that you're paying down on the debt with what we call depreciation, the lowering of your value of your property over time, because it's getting wear and tear. And so we're allowed to take a wear and tear provision called depreciation. So you get property taxes, you get repairs, you get capital expenses. What's a capital expense? This is something that a lot of landlords struggle with, is what do I have when they go to their accountant, they say, what do I have to capitalize? Meaning, what can I write off and what can't I write off right now? And so we have repairs or capital expenses. That's a question. We get a lot of it. We got a lot of new rules that are fairly favorable to the taxpayer, sort of changing the tide from you have to capitalize everything to you come to me, we'll go through it, and you'll capitalize very little when we're done. You capitalize amount paid to acquire or produce a tangible property. When you walk in and you buy a piece of property, all the costs that you paid to the title company and that all the related Freddie, Fannie kind of stuff, all that stuff gets capitalized into the cost of your acquiring the property. Capital expense creates a betterment and adapts to a different use or a new use or results in a restoration. These are new provisions. This is an interesting. A betterment adapts to a new or different use or results in a restoration. These are the key words that we're going to focus on now. For those of you who have properties, those of you who had to put on a new roof, those of you who had to put in new improvements, this is an important feature for you. To repair is to restore to a sound state, or to mend, or while a replacement constitutes a substitution. You took the old one out and you put the new one in. Another key question, definition is this unit of property. It includes all the components that are functionally interdependent. I'll go through what functionally interdependent means. It's placing one component that depends upon the placing in service of another component. So there are special rules. We're looking at this comes into play when you're particularly in the HVAC system and roofing. Now, a lot of you have had to go in and replace a furnace. A lot of you have had to go and replace an air compressor. Hopefully, it didn't get stolen. We used to say replacing that burned out compressor, that used to be a capital expense every time. But now we have a possibility, depending upon the amount of the compressor, that we can actually write off that compressor because the HVAC system is a unit of property. The whole HVAC system is a unit of property. So we have a furnace, we have duct work, we have an air compressor, we have all the wiring. And when you figure that out, you got to figure out, is this basically more than half of the unit of property? We know that at 25%, we're probably getting to the point we're clearly safe of this unit of property. Figure it out. How much is this compressor worth to the whole property? Anything basically under 50, I'm telling people to consider writing it off. So if what you're replacing, for instance, the roof, you're doing a re-roof, you're putting on new asphalt shingles on your rental, that you haven't replaced anything. This is a completely deductible expense. We used to have to capitalize that roof. So we like these new rules that let us do things like write off roofing and that sort of thing that we always used to have to capitalize. And when you do have to capitalize something, we get to estimate the value of what we're replacing and write that off. Because when you buy a house, do you ever get to know, how much is the roof worth? How much is nobody ever puts that into numbers for you. So you get to estimate it under any reasonable basis as to if I have to replace the whole roof and the roof trusses because I've got some serious structural problems. Yeah, you're going to have to capitalize the replacement, but that was probably at least a $10,000 roof you replaced. There's still a lot of value in that roof, but you've chosen to replace it. We'll write off the old roof and take a $10,000 deduction for it. So we've got these new rules, and I consider them to be a real opportunity for tax deductions. Because let's face it, how many of you want to pay tax on your rentals? Okay, that's the expected answer. And I'm here to tell you about the kinds of things that we're doing in the CPA world now with some of the new rules that we've got that we're really trying to get. I want you to all have positive cash flow, okay? Because who doesn't want positive cash flow? Okay, same answer. But the whole idea is if you have positive cash flow, we'll go back to this graphic here. If you have positive cash flow, we're replacing the principal you pay with the depreciation. If you have positive cash flow, the only place you can go to maybe wipe that out is to take depreciation and make sure that these expenses all get deducted, because if these expenses don't get deducted, you'll have positive cash flow and even higher taxable income. So that's what we're all about in the CPA world, is trying to take that positive cash flow that you get and turn it into no taxable income. And if you do this, if you get to the point where you can quit your day job, we can make your taxable income zero, and you won't pay any income taxes. But you have to get to the point where the whole point is I want you in positive cash flow, so you don't have to worry about some of these deduction rules, but we don't want you to have to pay taxes on it. So my goal on every client of mine is to make sure they get into positive cash flow properties and they pay no income tax on them.